for a decade and audited many employee benefit plans before I became a lawyer. I liked it so much, I stayed in the same field pretty much, and again, do retirement plans, executive compensation, and also health and welfare and other equity compensation matters right now for Holland & Hart. So today, again, Josh asked for if I could do some sort of retirement plan update for 2020. There's a bunch of things that have gone on in 2020, but obviously the one thing that stands out to everybody is COVID. And if you'd asked me months ago, my hope was that I wouldn't be doing a COVID update come August. I was hoping we'd be done by that. I've done one of these presentations back in April and hoped that was the last COVID presentation I'd have to do. But unfortunately, it's still here, and some of this guidance still is applicable. The other big kind of a piece of big retirement plan legislation that occurred, or that was effective, and it was technically was enacted at the end of 2019, is the Secure Act. I'm not going to cover the Secure Act today, but be aware that that was legislation that was enacted right before the end of the year last year, and a lot of its provisions apply in 2020. So make sure you're talking with your document providers and your TPA and making sure that everything's up to date on the Secure Act. And I recently did a presentation on the Secure Act. If anybody wants slides, feel free to reach out. But as far as COVID goes, before I get going, I'm just supposed to give a disclaimer. I'm not going to read this, but this is for educational purposes only. I'm not providing legal advice. If you need legal advice, speak with your counsel. And, these views are my views and not views of Holland & Hart and our other attorneys. So with that, we can get going. So this presentation today is going to focus on, it's really kind of two parts. The first piece is I'm going to deal with the CARES Act, just kind of run through the legislation and regulatory guidance that's come out with respect to COVID. And I think most plan sponsors at this point probably have a good handle on what those CARES Act provisions entail. A lot of people have already updated and amended their plans for it. But we'll still go through just to provide some background, and because it is still applicable. And the second piece of the presentation is just kind of to run through some traps for the unwary. There's a lot of kind of lurking issues, especially for companies that had layoffs or furloughed employees during the year. So just a number of issues there that I want to flag to make sure that they get taken care of now if they are an issue. So Josh and his team doesn't find them on next year's audit when they're doing the 2020 audits. So with that, we will start with the CARES Act. So there's a lot going on in the CARES Act in addition to the retirement plan components. However, again, we're just going to focus here on really the defined contribution retirement plan pieces of the CARES Act. There was a couple traditional DB pension plan, defined benefit pension plan pieces of the legislation. I don't think most of our audience today has defined benefit plans. But if anybody has any questions, feel free to ask. But again, we're focusing really on 401ks and 403bs here. The kind of four major pieces that we'll discuss are coronavirus distributions, the ability to increase the maximum amount of loans the participant can take, the ability to defer loan repayments, and the suspension of required minimum distributions. Really, actually, quick, the first three items here, the intent of these provisions was to get additional money, keep money in participants' hands. And this last one was to avoid forcing participants to sell at a time when the market was tanking, was at a low. So the first thing, which is kind of got the piece of the CARES Act legislation that has got the most attention as far as retirement planning goes, is coronavirus distributions. And what those are is the ability for plan sponsors to allow qualified individuals to take up to $100,000 from their plan, and actually all plans in the aggregate. So if a participant has assets at a former employer's plan or has an IRA, you'd have to aggregate that as far as that $100,000 limit goes. What it does is once you take this distribution, they are allowed to stretch out the taxation of it over 3 years. And I'll get into the tax in a little more detail. And it also waives the early withdrawal 10% penalty. So it's pretty significant there for those that are, again, under age 59 and a half. I'll talk about that a little later. To be a qualified individual, to be eligible to take a coronavirus distribution, the CARES Act said that you need to be diagnosed or adversely financially affected by COVID-19. They didn't provide any guidance as to what constitutes adversely financially affected. If you've been playing along at home, which hopefully most of you have not, the IRS has changed their guidance a couple times on this. Their most recent guidance came out a couple months ago now, an IRS Notice 2020-50. And what they've said is that if an employee, spouse, or a member of the participant's household experiences an adverse financial consequence resulting from things like quarantine, furlough, layoff, etc., then you are a qualified individual. Their previous guidance only said that if the participant themselves experienced one of these things, then that they'd be adversely financially affected. It didn't cover their spouse, which didn't really make sense to everybody, since certainly if your spouse, for example, lost their job, that could certainly adversely financially affect the participant. So the IRS, I think they clearly got enough comments from practitioners on that and plan sponsors, and they expanded their guidance. This is something that participants can self-certify. So as long as they meet those qualifications we just talked about, then they can essentially check the box and let the plan sponsor, TPA, whoever's administering these know that they meet those requirements. Some of the more recent guidance from the IRS has clarified that if a plan administrator has knowledge to the contrary, then they shouldn't permit a participant to take a coronavirus distribution. I think in most circumstances, it seems unlikely that a plan administrator will have that level of knowledge. I mean, maybe they know that, I don't know, Bob in marketing is single and has no dependents and hasn't been sick, and they haven't cut his salary and his hours remain the same, but that's asking a lot. So I think it's going to be extremely rare that a plan administrator would have knowledge to the contrary that somebody doesn't qualify. So pretty much if somebody asks, they're going to be in. And if there's abuse, then let's hope there's not. And I don't think it's something the IRS will be digging into in audits in the future, but they certainly haven't kind of revealed what they're going to do there. So there's really two ways you could get a coronavirus, or get the tax treatment rather, for a coronavirus distribution. The first and in kind of more obvious ways, plan sponsors are allowed to amend their plan to provide for this additional $100,000 or up to $100,000 distribution. And that's pretty straightforward. And I think a lot of document providers have reached out to their clients on their pre-approved plans and have already worked to put some of these amendments in place. But what's interesting is, and this was a little unclear in the beginning based on the CARES Act itself, but again, the IRS has clarified, is that any type of distribution is eligible if the participant is a qualified individual for that special tax treatment that we'll talk about in a second. So even if a plan wasn't amended to provide for coronavirus, special coronavirus distribution of up to $100,000. If a participant took a distribution for another reason, such as a hardship withdrawal, let's say they terminated and took their money out, they could still benefit from these tax breaks or the special tax treatment as long as they're a qualified individual. There's no real guidance yet that I've seen as to I see my mic's cutting out. Let me see if I can. I've used this for a bunch of presentations and I haven't had any problems, but all I have, unfortunately, right now is my computer mic. So I'll try to talk a little louder, but if it's a problem, let me know and I'll try to move it. In any event, there is, again, this you could still be eligible even if your plan wasn't amended to add this special coronavirus distribution. So it's still kind of waiting to see. I haven't heard of anybody that's taking advantage of this yet. I assume some participants are trying. I would think that's something that they'll have to work out probably between the TPA and probably not necessarily go through the plan sponsor, but it kind of remains to be seen how TPAs and service providers will handle this. As far as the taxation piece, as I mentioned before, I think the biggest thing with these distributions is that the 10% early withdrawal penalty is waived. So generally, if you are under age 59 and a half, there's a 10% early withdrawal penalty for most many types of distributions. So the fact that that is gone is a big help to participants, since they will be paying tax generally on these distributions. Also, the taxation can be spread over 3 years, which is nice. They don't have to take the hit in year one. And what's interesting, and the IRS has done this with some of their hurricane relief that they've offered in the past for areas that have been affected by some of these major hurricanes, is that the distributions can be repaid within 3 years. And if that happens, then it'll be treated as a rollover, so as if it's tax-free. Now, I don't think many participants probably aren't going to be repaying these if they need the money. It's probably unlikely that they'll have the money in 3 years to contribute back to the plan. But if they do, they will have already paid tax on it, or at least some amount of tax on it, because if they spread it out over 3 years, that's done ratably. So in any event, some amount of tax will be paid. So participants will need to amend their tax return to get a refund of those taxes. So there's a little bit of a hoop to jump through, but if the dollars are significant, and participants probably will go through with that. But that shouldn't be anything that the plan sponsor needs to deal with. I mean, the service providers will be responsible for 1099s and make sure the taxation's right. And if participants amend their returns, and that is on them, not the plan sponsor. I mentioned before, this is an optional provision. It can be implemented at any time, and I think many plans already have. And a formal amendment isn't required until December 31st, 2022. And again, a lot of plans are doing it now. If you do decide to, if you've enacted these rules but haven't actually done the formal amendment, I certainly recommend that you do some sort of board resolution or somehow formally document the effective date that you begin offering these benefits to participants, and then obviously follow up with the amendment before the deadline. And the last thing I wanted to add here is, and again, it might be a little late because I think most of these amendments or many of them are done, is that some safe harbor notices, if you are a safe harbor plan, provide enough detail as to the different types of distributions that are available under the plan. So if your safe harbor notice is one of these that provides a lot of detail, doesn't keep it pretty high level and generic as far as distributions go, then you may need to amend that notice to add this additional type of distribution if you've added it to the plan. And I believe Fidelity's taken the position that their form safe harbor notice needed to be amended to add this. Again, you could argue that it's not necessary, but I think to be conservative, clearly at least some service providers are recommending this. So now we will move on to the CARES Act loan limit increases. This, like actually these CARES Act provisions we're going to talk about, again, it's optional and doesn't need to be adopted until, formally adopted anyways, amended rather until 12/31/2022. But this again affects qualified individuals. We're talking about the same definition we used for coronavirus distributions. That allows plans, if they want, to increase the maximum amount of maximum loan limit up to $100,000 from the previous $50,000. Still the highest balance in the last 12 months. That still applies as far as calculating the available amount of loan that you're still able to take. But again, plan sponsors can raise that limit. This only applies, though, to loans that were taken within 180 days of the enactment of the CARES Act. So that's between March 27th of this year and September 23rd. So time's running out. If a plan sponsor hasn't adopted this and they want to, it's a pretty limited window at this point. And if they have adopted, it's important to make sure that they're aware of that September 23 end date to make sure that they don't allow loans that exceed that 50,000 threshold after that date. The other loan piece of the CARES Act dealt with the ability to defer loan repayments. Again, qualified individual, you need to be one to defer loan repayments. And again, this is optional. But plan sponsors can permit participants to defer their loan repayments for up to a year. And this applies to any loan repayments that are due after the enactment of the CARES Act. And it applies to any loans taken prior to 12/31/2020. So even if a loan was taken pre-COVID in a prior year, as long as those loan repayments are due in 2020, then the payments can be deferred. So again, this is designed to keep a little extra money in participants' pockets as they navigate COVID here. And if loan repayments are deferred, they will continue to accrue interest, and they will need to be re-amortized once repayment starts. And again, these are subject to the same amendment rules by 12/31/2022. The final piece of the CARES Act that we'll talk about is suspension of the required minimum distribution rules. I think as most of you know, if you reach age 70 and a half, or I guess now, thanks to the Secure Act, age 72, at least in 2020, you reach age 72, and you are no longer employed by the company, or at least if you're not an owner anyways, then you are required to take a required minimum distribution from the plan. That's because the IRS has deferred taxation long enough. They want to start taxing a piece of your deferred balance. So those traditionally are not eligible to be rolled over into an IRA or into another plan. So what the CARES Act has done for plan sponsors that choose to adopt this is they waive the requirement that plan participants take a required minimum distribution for 2020. And that also includes waivers of 2019 RMDs that were to be taken in 2020. So the first year that you are required to take an RMD, you can defer that to the following year and have 2 in the first year. That would cover these RMDs as well. So again, they're treated as if they're eligible for rollover. There's no taxation here. So you could roll the money that otherwise would have been an RMD. If you're able to into an IRA now, that's not a problem. And there's no eligibility requirements. So those other provisions we talked about, you need to be a qualified participant or individual. That's not the case here. This applies to everybody. And I think the reason is, again, anybody who would have been forced to liquidate part of their account to take an RMD would have been doing so when the market was very much down. So they were trying to provide some relief there. That would affect anybody, even if you're not technically affected by COVID-19. Some recent guidance that came out from the IRS, they've clarified that if a participant already took an RMD during 2020, then that amount can generally be rolled over back either into the plan that it came from or into an IRA on a tax-free basis if it's done by August 31st of this year. So we're running out of a window here. But if anybody's done that and they want to get that, they don't want to pay tax on it, they'd like to roll it over, it still can be done, again, as long as we do it in the next couple of weeks. And again, same amendment requirements, needs to be amended by 12/31/2022. So the CARES Act was kind of a significant piece of COVID-related legislation that affected retirement plans. And this really the most significant piece of DOL regulatory guidance that came out was in the form of Disaster Relief Notice 2020-01. And I should say EBSA. EBSA is the Employee Benefit Security Administration. They are a department, part of the Department of Labor. So this is the DOL guidance. And at a really high level, what this does is offer quite a bit of relief from many DOL and ERISA rules and regulations. If plan sponsors have been adversely affected by COVID. And the guidance here the DOL put out, it's been blessed by other agencies. It says in the guidance of the Treasury, Health and Human Services, the IRS they're all on board with this to the extent that it overlaps with areas that they have jurisdiction over. But it does not in any way replace the rules of those agencies. So this is really a DOL only thing. And if there's some overlap, it doesn't change deadlines or anything like that for these other agencies. Really, one of the biggest pieces of this disaster relief notice was to provide an extension for ERISA and DOL notices. So what the DOL says is that they won't consider it a violation for failure to timely furnish a notice, disclosure, or a document that is required to be furnished during the COVID outbreak period. And the outbreak period is something that is defined in this notice. It's defined in some other guidance that's come out that's been jointly issued by the IRS and the Department of Labor. And so it's being used in multiple instances. What the outbreak period is the period from March 1st, 2020 through 60 days after the end of the COVID national emergency. So for those of you that may be aware, President Trump declared a national emergency under the Stafford Act back in March, and that national emergency is still ongoing. There's still no end date to it. When he eventually does declare an end date to the national emergency, 60 days after that end date, that is when the outbreak period starts. So any notices that are due in that period, you have some, as a plan sponsor, some leeway as to when they are furnished. That being said, plan sponsors need to act in good faith to try to furnish any notices that are due as soon as reasonably practicable. So just because you may have a little more time, if you have it ready to go, there's no reason to delay it. That's one way to guarantee you'll never have any challenge. The DOL hopefully won't be ever challenging this, but you don't have participants complaining about lack of notices. So to the extent you can timely furnish notices, you should do so, but you do have some breathing room if you can for whatever reason. And this disaster relief notice provided a little preview. Came out a few weeks before the new DOL electronic disclosure regulations. They said that despite at the time the current regulations were really defaulted to paper unless somebody had access to a workplace computer, and there's other rules in the old DOL electronic disclosure regs. Anyways, this notice said you can ignore those regs. You can furnish everything electronically. That includes your websites, email, and they even specifically mentioned text. I can't imagine anybody would be texting out the latest SPD, but you never know, you could, and you would meet the requirements of this notice. And you still need to have reasonable belief that the participant has access to whatever means of communication you're using to reach them. And now, again, since this notice came out, the DOL did roll out their new e-disclosure regs. And now things have shifted really to a default electronic disclosure format as opposed to paper. So again, this kind of dovetails with that now, which is clearly what they were going for. Just really quick, some of these notices that this would cover things like summary annual reports, summary plan descriptions, quadrant notices, things like that. So really, for the most part, any DOL notice could fall under this relief. The DOL also decided to cut plan sponsors a little slack on loans and distributions from the plan. They said that if a plan sponsor has failed to follow the procedural requirements for loans and distributions, then they won't treat it as a failure. If the failure is attributable solely to COVID-19, plan administrator makes a good faith effort to comply with the plan's terms, and the plan administrator makes a reasonable attempt to correct it if they make an error. So again, to the extent that you can comply and operate the plan in accordance with its terms and procedures, you should absolutely do that. But again, if there is some sort of breakdown as a result of COVID, maybe some staffing issues, if there's layoffs or furloughs, you do have some slack there. This is kind of an obscure point, but I think it's worth pointing out. This only applies to areas under DOL jurisdiction. There are certain pieces of distributions and loans that fall under IRS purview because they're in the Internal Revenue Code. For example, if a spousal consent was required to take a distribution under a plan, let's say they had a joint survivor annuity option under a plan, the spouse wanted to waive the ability to waive that annuity. That's something that's in the tax code, so you wouldn't be able to just not get spousal consent, or at least the IRS hasn't provided guidance that would allow that. So just be aware that this, again, really covers DOL and ERISA related aspects. The notice also provides relief specifically for plan sponsors that choose to implement coronavirus distributions and the loan relief, the extension of the $50,000 to $100,000 loan amount, and the deferral of payments. So as long as plan sponsors have made a good faith effort to to implement those provisions, the DOL hopefully will not be dinging you on a future audit. And they've also chosen to provide plan sponsors a little slack on participant contributions and loan repayments. Now, hopefully at this point, Harris has drilled into everybody's head the timing rules with respect to participant contributions. Generally that they must be contributed to the plan in the earliest date. They can be reasonably segregated from the sponsor's general assets. The second piece of the definition, then not later than 15th business days, the month following the month in which contributions withheld. For those of you that have ever been audited by the DOL, you know that that absolutely does not apply. And generally, the DOL takes the position that assets can be segregated from the sponsor's assets, usually on the payroll date within 1 or 2 or maybe 3 days following. So that should always be the standard, and I'm sure that's what you've heard from Harris. But that should be the standard to try to hold yourself to, just a few days at the max. Unless you're a small employer, you have less than 100 people, you're not getting an audit, but you do have a 7-day safe harbor to get contributions in. But in any event, the DOL has said that they will not enforce this rule during the outbreak period if the delay is related to COVID. So if your payroll person, for example, was out for a few weeks because they contracted COVID, then this may apply to you and you may have some slack here. So that's something to keep track of and document for next year's audit, so you can explain to Harris why a few weeks took longer than those few business days. And again, you need to comply as soon as administratively practicable. So this does not give plan sponsors a reason to just sit on contributions and hold them for a few weeks, even if you have somebody that is involved in the process that came down with COVID. You should absolutely make a good faith effort to get contributions in as soon as you can. But again, there is some relief here if you need it. What is still kind of an open item is this still would be technically, if a contribution is delinquent, it still technically would be a prohibited transaction. And while the DOL has said they will enforce that if it's due to COVID, the IRS hasn't offered any guidance as to whether they will enforce it. So it's entirely possible, though probably unlikely, that if you do have contributions that would otherwise be late due to COVID, that the IRS could say there's still an excise tax due on, the earnings need to be contributed and excise tax due on those amounts. So we'll see if the IRS offers any guidance there, but so far there hasn't been anything. This piece, the disaster relief notice, I don't think we need to spend a lot of time on it. So blackout notices, they specifically have a section of blackout notices. If you are changing funds, changing service providers during this pandemic, then you have some relief there as far as getting the notices out. But again, like anything, make a good faith effort to comply as soon as you can, and it shouldn't be problematic. And the last piece of the disaster relief notice is that they just kind of threw in a general fiduciary compliance catch-all in there. And they specifically acknowledged that there are going to be ERISA compliance challenges for some plan sponsors because of COVID and the impact of COVID on companies. So they have said that they will take kind of a light hand to enforcement and emphasize compliance assistance and include grace periods and other relief where it's appropriate. So, they even threw out a guiding principle in there that if plan sponsors act reasonably, prudently, and in the interest of plan participants, then they will work with plan sponsors and rather than dig them, work with them to make sure their plans are in compliance and not go after them on audit. So hopefully, hopefully they'll do that. There's no indication that they won't. That, I believe, is my last slide on the disaster relief notice. That really covers, a quick run through of the major legislation and the guidance, regulatory guidance that's come out. The next piece of this, we'll just kind of go through some issues that might be lurking if you're not, for things that people might not be thinking about. And these are, often could end up being operational issues and operational failures that could arise, again, on next year's audit. So it's good to flush them out now and make sure that they're corrected now if any corrections are necessary. So first, we'll just talk really quick about delayed notices. I mentioned a couple times I was going through the disaster relief notice. That only, again, applies to DOL notices, so it would not cover IRS notices. So the safe harbor notice, for example, that's a requirement of the tax code, and there is currently no relief to providing safe harbor notices. If you have a safe harbor plan, you still need to get your notice out at the end of this year for next year, unless, again, the IRS comes out with some subsequent guidance. And just be aware, after that outbreak period ends, whenever it is, we don't know, just obviously be aware that the notice deadlines will revert back to their normal timing, so don't get caught off guard there. That way you have some leeway now. Things will eventually go back to normal, hopefully sooner rather than later. As far as 5500 filing goes, there has been no 5500 filing relief for calendar year end plans, which I assume most of your plans are. At this point, if you haven't filed, it was due on July 31st. I assume then you filed an extension, so those are still due on October 15th of this year. There was some filing relief for non-calendar year end plans, but for whatever reason, the Department of Labor and IRS chose not to extend that relief to calendar year end plans. So it remains to be seen if there's some last minute concerns that plan sponsors aren't getting their 5500s in due to COVID. Maybe it'll be something, but there's been nothing that I've heard anyways that's lurking. So get those 5500s filed with your audit report by October 15th. These next few slides will kind of run through issues that have arisen with some plan sponsors when they've furloughed employees or laid off, terminated employees, and then subsequently rehired them. There are just really some things that, again, plan sponsors should be thinking about. And really quick, when we talk about furloughed employees, there's no definition in the tax code or ERISA as to what constitutes a furlough, but generally, we're talking about employees that have not been technically terminated. So they're still employed, maybe their hours have been reduced, their pay has been reduced, maybe they're not working at all for a period of time, but if a company still considers them employed, they haven't had that separation of service, that's what we're talking about when I'm talking about a furloughed employee. So with service crediting, things to think about with furloughed employees, just the impact that furlough will have on the elapsed time method of service crediting, both for eligibility and vesting or hours of service. Since you're not terminated as a furloughed employee, that elapsed time method is still going to keep ticking. So even if you didn't work for 6 months, you still should be under the elapsed time method credited for those 6 months of service. So again, that could make a difference, again, for eligibility and vesting. If your plan calculates service based on hours of service method, generally it's 1,000 hours of service. 1,000 hours is equal to a year's service. If those furloughed employees aren't working, then they wouldn't be earning any service credit. So just be aware of how that works and make sure that you and your TPAs are on top of that and service crediting is calculated correctly. Also, because a furlough participant was never terminated, as soon as they return to employment or start working full-time or whatever basis they worked at before, they should be immediately eligible to jump back into participation in the plan. So it's important to make sure that happens. For participants who are laid off and then subsequently rehired, generally they won't receive any service crediting during their layoff period. It is possible that a plan can bridge crediting if a plan document is amended to do so, but it's rare, particularly in a pre-approved plan environment. You do see that sometimes with individually designed plans, but you might be able to amend your pre-approved plan to provide some sort of bridging, but it's not going to happen unless there's a plan document that specifically provides for it. And for rehires, if they were eligible to participate in your retirement plan immediately prior to their termination or their layoff, then they will be immediately eligible to participate in the plan once they come back in. Now, I'll talk about it in a minute. They might need to re-enroll in the plan, but they're at least eligible to participate. So, as I just alluded to, continuation of deferrals is something to be thinking about as well. For someone who's on furlough, even though they're not getting paid, as soon as they start getting paid again, their hours come back up, their previous deferral election still should be valid, unless, of course, they've gone out and made a change in the interim. But if they went out at 10%, they're going to come back in at 10%, barring, again, some intervening costs. Now, this is going to be different for participants who were laid off or and subsequently rehired. For these people, it's going to depend on the terms of the plan. Most plans, once you terminate employment, a lot of plans actually are silent as to whether or not your previous deferral election is reinstated upon rehire. But some plans certainly have provisions where if employees rehired within 12 months or some other shorter period of time, then that previous deferral percentage will be reinstated. So it's important to know what your plan says and make sure that you're following that with respect to rehires. And if the plan doesn't provide for an automatic reinstatement, then participants may need to make a new election. So that's something that should be communicated to participants, so they're not sitting there assuming that, even because if they were laid off for a couple months, they might be under the impression everything will start right back up. But no, they may need to go out and re-enroll in the plan. And also it's important that plan sponsors are aware of whether or not their auto-enrollment provisions, the plan has them, applies to rehires. Some plans, rehires are auto-enrolled. Some plans, they aren't. So, maybe if someone's rehired, even if it's, some short break in service, maybe they need to be auto-enrolled if they don't otherwise make an election. So again, it's important to make sure you're following your plan's terms as far as these rehired employees go. Participant loans is another area where there tends to be issues. So if an employee's out on furlough, if they are not receiving any compensation, they're obviously not making plan or participant loan repayments through payroll deduction. Maybe they're able to make them, or they were making them outside of payroll directly to custodian, but maybe they weren't. So it's something you need to think about, and your TPAs need to be thinking about, were loan payments, did the loans end up getting defaulted while someone was out on furlough? So do they need to be deemed? Is there any relief available? Maybe you can invoke that, you can use the deferral of loan repayments under the CARES Act to provide some relief there. So there are some options there, but it's something that plan sponsors should be thinking about and working with their TPAs to make sure they're handling properly. And some of the same issues arise with rehired participants. Were they able to continue making repayments outside of payroll? If they were, then great, their loan hasn't been defaulted. But what happens when they're rehired? That previous payroll deduction, their agreement previously when they took the loan to repay the loan through payroll deduction, that might no longer be valid since they terminated employment. So you may need to, have them enter into some other agreement that affirmatively states that they're willing to have their payroll reduced to cover loan repayments. So that's something that, again, TPAs probably have some insight into this as to how it works with the administration of your plan, but it's something you need to be aware of. Just setting them back up in payroll, they could raise a wage and hours claim potentially if they haven't authorized that. This would actually apply to furloughed employees as well, but if loans have been defaulted, you're past the point where they can be corrected and the deferral of loan repayments, that relief doesn't work, then it's possible that, if you as a plan sponsor wants to go and help these participants out, they can be corrected through the IRS's corrections program, which is the Employee Plans Compliance Resolution System. Those can be self-corrected now, so if you're still within that original term of the loan repayments can be re-amortized and repaid over the remaining life of the loan. So there's some relief there as well. But again, that's something that plan sponsors would need to do for their participants. Participants can't initiate that by themselves. This, I think, is going to be a big one for many plan sponsors, and that is partial plan terminations. And for those that aren't aware of what a partial plan termination is, the IRS is taking a position that if more than 20% of a plan's eligible participants have been involuntarily terminated during a plan year, that a partial plan termination has occurred. And a partial plan termination requires that all terminated employees, regardless of whether they were involuntarily terminated or not, need to be fully vested. So, this is a kind of something that sneaks up on plan sponsors. So if they're not thinking about it And then next year audit, the auditor say, hey, looks like we had a partial termination here. All that money that you was forfeited and you've since spent, used to fund future contributions or pay for expenses, that needs to be put back into the plan, and then it needs to just be distributed to these people who have already taken distributions from the plan. So it really creates kind of a nightmare to kind of go back and retroactively deal with vesting on a partial termination. So if you have had layoffs during the year, then this is something that you should be thinking about to make sure you haven't crossed that 20% threshold. And actually, when you're looking at this, generally you're looking at the plan year. But this crosses multiple plan years. If say layoffs start at the end of this year, that go into next year, and then you look at a larger period than just a plan year. So again, think about too, the impact of furloughs. If someone's furloughed back in March, they're still not rehired. Are they going to be rehired at this point? Could it be an involuntary termination? Things like that. The IRS, could be looking at that at audit on the future. And also the intent to rehire. So maybe you have furloughed somebody or you did lay them off and you intend to bring them back next month. If you do actually bring them back, then there's no question that they should not be counted in the involuntary termination figures. The IRS actually recently just said that in FAQ. But if you intend to bring them back and you're going to do so soon, maybe early next year, then maybe you can exclude those. There's maybe some wiggle room here, but that's something you should again be thinking about. And this, I should add, it does not apply to 403B plans. I think we have some not-for-profit organizations on the call today, so this will not apply to 403B plans. And I just alluded to this, but be thinking about previously forfeited amounts. Kind of be cautious before using them. Do an analysis to see if a partial plan termination might be, might have occurred. You don't want to spend those forfeiture dollars before reallocate them or whatever, before you know if they need to be restored to participants. And same goes for rehired participants. If a participant is rehired or terminated rather, they take their distribution, their money's forfeited. If they were hired, shortly thereafter, as things have turned around for the company, if they repay that distribution to the plan, then the plan generally is required, unless it's been essentially 5 years, generally required to restore those forfeitures to those participants. So if there's been some layoffs and you're doing rehires now, maybe it's worth monitoring that before you use those forfeitures. Though again, I'm not in any way saying the forfeitures shouldn't be used by the end of the year. You absolutely should make an effort to use all forfeitures in the plan by the end of the year to make the IRS happy. Suspension of match is another thing that I've seen a lot of companies do as a result of COVID. And be aware, unless your plan provides for a discretionary match, an amendment is required to suspend or eliminate or reduce the match. So those need to be done, as soon as possible if you're planning on doing an amendment. And if your plan is a safe harbor plan, and you wish to amend it to remove the safe harbor, 30-day notice is required in advance of that suspension. So it's important, particularly if you're still planning on, if you haven't done this yet, to get that safe harbor notice out within that 30-day period. There is the other thing that the general rule for if you're eliminating or reducing a safe harbor match is, and also for non-elective safe harbor contributions, that your safe harbor notice needed to permit some, it's called the maybe not language, where you say, we're going to make this contribution, but we might not if we choose not to. If safe harbor notice doesn't have that, the IRS has provided some relief as long as the amendment to eliminate the safe harbor is adopted by August 31st. So it's coming right up. But that gives sponsors the ability to do that without having that language in their annual safe harbor notice. And if you do decide to eliminate your safe harbor notice, just be aware that you'll lose safe harbor status for the entire year. You don't get partial credit. So ADP testing, non-discrimination testing will be due, top-heavy testing for the entire plan year. And it may be possible to retroactively reinstate match if you go with a discretionary matching contribution. Let's say you got rid of your safe harbor contribution, you went to discretionary, but right now your match is at 0%, because you don't know if you're going to make a matching contribution for the remainder of the year. Once you get to the end of the year, you still technically, if you have discretionary matching contributions provisions in your plan, technically have until essentially when your tax return due date for the company with extensions to decide whether or not to go back and make a matching contribution for that year. So you could go back and say, oh, I want to match, financial results ended up being good in the fourth quarter. I want to match October through December. You can do that. You can make that decision again in September of 2021 and go back and contribute that match. So there is some flexibility there if things turn around for companies. And that is my last slide. And I think I'm going to turn it over to Josh. I think he has a few things to say. And after that, we can take some questions.
Yeah, thanks, Ben, for giving me. That was great. I think it's, I do have a couple questions that have come in privately I'll ask, but I thought it was very interesting, that they make all these rules and then it's kind of the DOL's way of kind of interpreting the rules through just how they enforce. So you're not really sure how they're going to interpret it. You highlighted the timeliness rule, which I know as an auditor, we harp on consistently for it seems like it's been forever, but
hot topic for decades, it seems.
Yeah, and so, and then the 15-day, but reasonably soon, is it 3 days? You said it, all the different rules, and then the DOL interprets it, well, if one person goes on vacation, that's not an excuse, and now they've given us this leeway for COVID. I think from our standpoint, we're not really sure how they're going to interpret that or what's going to be required. I know we're probably fairly cautious in that we would tell people just one thing that's pretty true when the DOL comes in is that the more documentation you have to show that you were trying to follow the best practice you could, the easier they are. They kind of back off a little bit. Whereas if they come in and nothing's documented and nothing is shown, then they start to they keep on taking it to the next step. So I know if you do have those kind of issues or COVID has caused delays or something like that, especially if you're a plan that gets audited, your auditors are going to be looking for documentation and maybe a memo or something discussed in the trustee meeting or something like that. Just anything to help document why that occurred, because I think that'll be important. Doing it after the DOL's already come in is too late in their mind. So having documentation is going to be important with all these different things that you highlighted, and understanding that. With that, Ben, one question came in, asked about the CARES Act distributions and qualified individuals. Will they have to provide documentation that they were adversely financially affected, similar to like a hardship distribution?
No, again, it's a self-certifying standard. So as long as, again, I don't know in practice how, plan administrators are actually doing it, but as long as the participant says, hey, I meet these requirements. The box, essentially, that's all they need.
Okay. And then the other question that came in asked, so there is currently no plans to extend the loan period beyond the 180-day time frame from the CARES Act.
That's right. As of now, it's still that 180-day window. It's kind of interesting, right? I think when this legislation was enacted, I think everyone's hope was that we still wouldn't be dealing with it now. So it's kind of interesting to see if some of these provisions will be extended, because I could also see them, potentially, and this is just me thinking out loud, I'm not aware that this is happening, but I also could see them extending the ability to defer loan repayments, because we still might be adversely financially affected by COVID next year, But right now, no, we're still stuck with 180 days.
Great. I think that was so far all the questions that I've logged that come in. But I'd like to.
Let me just jump in, Josh, really quick. There was a question scrolling through my chat that came in privately to me about whether if a taxpayer takes more than the RMD amount for 2020, can they roll the whole amount back into the plan? I don't know if the guidance covers that. I suspect the answer is probably not, but it may be possible. If you take a look at IRS Notice 2020-52, which covers the RMD provisions, or again, talk to your administrator on that. They definitely, that's the notice that provided guidance on this. So there's no question you can at least roll the RMD piece back into the plan. The rest of the amount, You might be able to. I'm just not sure.
Excellent. Well, I'd like to thank Ben again from Harris. At least it's just been absolutely wonderful. Tons of great information.
Hey Josh, sorry, I'm scrolling through my chat. There isn't one more question.
Okay, all right.
And
we have a few more minutes.
The other one was towards the top. This one's at the bottom.
Okay.
After through all the mic issues, so I apologize for mic problems. It's the first I've heard of it. I've done a handful of these from home. But anyways, just really quick, there was a question as to whether DOL, with regards to DOL enforcement, with a state shutdown of work from state shutdown of work from the office when they were required to work from home, would that be considered COVID related? And I think the answer is yes. And that gets back to what you were saying, Josh, as far as documenting your reasons. Don't just document your reasons you didn't comply with a DOL rule with respect to contributions alone. Do it for everything. If you can point to documentation that says that this didn't happen because of X, Y, and Z, I think that's going to be a huge help. And it's not going to just be limited to some key person who's involved in the process, contracting COVID and getting sick. If everyone's forced to work from home, especially in the beginning of before everyone had the kinks worked out, there are going to be things that slip. There still could be issues now because businesses might be scrambling, focusing on business issues instead of dealing with their retirement plan where things slide. So anything that you can point to and say that was at least tangentially affected by COVID-19, do it and document it. And hopefully, if the DOL ever does come knocking, they can see that and say, oh yeah, that's fine. We've excused this behavior essentially because we recognize that you were affected by COVID. That's all I have, Josh, promise.
All right. Well, I'll thank you again. Thanks again for coming on, and thanks to everyone for joining. Hopefully you got a lot of good information like I did from this. If you have any questions, feel free. You have Ben's information there. You have I think everyone on the call has my information or Tara's information. Harris CPAs, we have a website for specifically for our benefit plans. I know on it, Derek, lastly, part of our team actually wrote a little blog on partial plan terminations and stuff like that. So we've been working on that stuff throughout the summer as well. So a lot of information out there, and hopefully if you have any questions or need anything, we can get you the answers, so hopefully, or the right information, or at least talk to you about it. So again, thanks Ben for joining, and thanks everyone else for joining, and I hope you have a good afternoon.
Great, thanks for having me. Thank you, everybody. Take care.